All right, this week's quick value is Ziff Davis. Ticker is ZD. You can see this chart, right? It was a $100 stock a couple years ago. Now it's $40, so down 60%. I looked at it, I don't know, 2 years ago or so, and it looked fairly valued at the time. But now I thought I would take another look just with how much shares are down. So the stock, here's my workbook at $42. It's a $1.8 billion company market cap. They don't have a ton of net debt, 200 million if you count some long-term investments that are sitting on the balance sheet, which I did. So it's about a $2 billion EV. This company spun off Consensus Cloud CCSI, the eFax company, back in 2021, I want to say. So this is the RemainCo stub. And these are, I don't know, a collection of internet media and subscription companies and a handful of different verticals. Kind of reminds me of IAC. So they get their revenue from advertising, right? Clicks, selling some product, subscriptions, right? They've got like the Viper security business, which is kind of like a Norton security type company. So just a handful of what I would call old school legacy internet and media brands. That's the business model in a nutshell. And it's interesting. It's interesting because the fundamentals are I don't know, I think they're pretty stable. So the business hasn't really grown much. This is 4 years projected to be 4 years of flat revenue and flat EBITDA, right? So 1.4 billion, right around 500 million of EBITDA. 2025, they expect to step up 5 to 6% on each line item. Now, part of that is because of some recent acquisitions, but starting to break out of that stability trend. So fundamentals, I would call them stable, even though the share price is down 60%. So that's kind of point number one, if you will. The second, you've got really, really good cash flow. So this is 1.8 billion market cap. And in the last 3 years alone, they've generated 725 million of free cash. 725 million of free cash. They spent 330 million on M&A, 372 million on buybacks. So the share count's down. Share count's down, what is this? More than 10%. 47 million, 43, and they're still at it. I'll get to that in a moment. So shareholder friendly management, clean balance sheet. So I would call it very conservative balance sheet here. On the free cash side, we've got free cash per share that's up a good amount. So 662 in the latest year, and that's on a $42 stock. So pretty cheap on both EBITDA. Where's my summary? Here we go. Less than 4x EBITDA and less than 7 or 8 times free cash, even if you go back a couple of years to lower numbers. And I think what the market's saying is their M&A strategy may not be a value creator, right? So 330 million of M&A. Yeah, they took some impairment charges in the last 3 years, probably about half that amount. So I think you've got a market telling you M&A is not real value creating. And so I just looked at it and I took this 330 million of M&A and said, all right, maybe they're spending 111 million a year, just a 3-year average on tuck-in M&A, and that's really keeping them running in place. So call it CapEx. So, I get to $4 a share in the most recent year when you strip out 111 million of M&A. So that makes it a more reasonable 10x free cash, adjusted for M&A as CapEx. So maybe the market's saying, look, this thing's pretty fairly valued when you include the M&A spend as part of your free cash flow calculation. I don't know, just a hunch. But I do think this is a good cash generating business, right? It just comes down to future capital allocate. Well, it's cheap. It's cheap, and future capital allocation will help drive where it goes next. This is a quarterly view of cash flow, and I thought this was pretty interesting. So you have a period here. Let's see, maybe all of 2023 and the back half of 2022. Almost no M&A, 20 million, right? 20 million of M&A. They did some buybacks, 111 million of buybacks during that time frame. No real activity on the balance sheet. So a pretty slow period of capital deployment for 6 quarters, right? Year and a half. 200 million total capital deployed. Then in 2024, 538. They spent 10 times as much on M&A, in the last 4 quarters than they did the previous 6. So it looks like they're starting to get a little bit more aggressive on deploying cash. Big acquisition in Q3. Aggressive buybacks recently. So it just looks like they're kind of turning on the capital allocation spigot, if you will. I think that's sort of interesting. And here you can see median multiples, free cash, right? This thing has just been a slow drift lower. So it doesn't matter what valuation metric you pick, it's cheap based on long run averages. So I think the hang up might be on the M&A front. Maybe it's the businesses. I mean, I look at some of these. Where's that chart? Yeah, CNET, IGN. Maybe IGN's a decent. PC Mag, Retail Me Not. What are these businesses going to look like in 5 or 6 years? I think it's probably pretty hard to tell, right? I wouldn't call them like high moat businesses necessarily. So maybe that's a big reason for this deserving to trade at a pretty low multiple. But I took a stab at valuation. What I do, I used 8 to 10x free cash on my estimate. I got 290 million, 675 a share. So using 8 to 10x multiple, you got a $54 to $68 stock. Pretty interesting, right? And their guidance, which I think looks pretty reasonable, doesn't include any M&A or buyback activity, which just seems really unlikely. So I think that's maybe a conservative fiscal 25 outlook. So it looks like kind of an interesting story. Maybe some hair on it, maybe a crummy business model, if you will. Fundamentals look pretty good. EBITDA converts into cash flow at a good rate. So I don't know, looks pretty interesting. I did buy a small position, so disclosure, I own a couple of shares, not a huge amount, but I thought it was worth hanging on to while I do a little bit more work to better understand this business model. So if you've looked at it, send me a note. Let me know what you think. And here's my full write-up at valuedon'tlie.com. This is number 261, Ziff Davis.